We are going to explore in this presentation the price of money, which is really the essence of finance. To do that, we're going to go through three related questions. The first is to examine the desire for money, and that will give us an indication of the demand for it and an indication of the interest rate, perhaps, if we rely on demand as one of the forces that give us a price for money. Then we're going to outline the financial theories of interest, look at how they benefit us, what we can use those different theories to tell us, and lastly we're going to describe the mechanics of money and finance in Western society and look at exactly how the stuff of money works and what its economic implications are for real estate finance. When we look at money, we know that it's the one thing that everyone wants more of. The curious thing is that everyone always wants more money, to the extent that economists are very comfortable to believe that humans have infinite desires. We certainly have infinite desires for money. If you have $1,000, you would like 10,000. If you had 10,000, you'd prefer $1 million. If you had $1 million, you'd think you're in the little league because you really want to have $1 billion, and so on. If we compare these desires, the desire that we have for money, and contrast it to the desires we have for other things, we find that it's fundamentally different. Certainly, we would like more things, more comforts, more food, clothing, shelter, maybe motor cars, trips overseas. But when we look closely at these things, we find something rather peculiar about them. Let's take motor cars. I would like a Lamborghini. I might even like two, maybe one for each of my children. By the time I've got maybe 20 or 30 Lamborghinis, I would probably be becoming a bit bored with them. In fact, they'd be starting to clog up my garage. I could say that my demand for motor cars, even the most attractive motor cars on the planet, is actually limited. I can see this quite evidently with food. I might be very keen on dinner, and I might go to a fancy restaurant, and I might be strong in my demand for a good meal. But after I finish that meal, do I want another 2 or 3 or 10 meals? Not really. And we can go through all of our other desires as well. What we find is that in every case, human desires for real things are limited. And in fact, they're not just limited, they become negative. Imagine sitting down to 50 kilos of ice cream and being told that because you like ice cream, you have to finish it all. It wouldn't take very long before most of that mass of ice cream would be quite a burden. It would probably kill you. So what we can conclude is that human desires are not unlimited. Human desires are limited. However, money is peculiar, and the reason that we want it without limit is because it actually satisfies no desire. My desire for a sports car is satisfied by my first handful of Lamborghinis. What is the desire that money satisfies? There is none. Because it's only physical, real desires that actually give me any form of satisfaction. Now, these might be the things that money can buy. Money can certainly buy me my Lamborghinis. It can buy me my houses and estates. It can buy me my travel and my clothes and so on. But money is not the clothes, not the houses, not the holidays. It is something else. When we look at exactly what money is, we find that in fact it's quite barren. It really does nothing at all for us. We don't really like to wear money or eat it. You can't drive it around. On occasions, when communities collapse, you might end up with a truckload of money. It's all just useless. Doesn't even burn well in the fireplace. That's because the thing which attracts us with money is not the stuff of money, not the gold or the paper or whatever it is. It is the notion of stored wealth that it represents. And it's an abstraction. It's not actually real. Aristotle noticed this over 2,000 years ago. that money is the only object of human desire that is never satisfied. And this means that our appetite for money in our work lives will never be satisfied. We have to find some other way of finding economic satisfaction. This is all very nice to consider Aristotle and our eventual desires. What does this say for the price of money? Well, the problem it presents is that it means that our desire for money cannot give us a price for it. It cannot give us an interest rate. That has puzzled economists almost through the entirety of recorded human history. In the last 500 years, there's been a special attention to the question of the basis, the justification, the theory of interest. That work has increased in intensity over the last century, and we could say that the 20th century was marked by particular attention to trying to work out what gave money its price, what set the interest rate. We find that we have about 5 major theories of interest, and these are all important for the property economist to be aware of. First of all, they do have some usefulness, but in fact we will find that most of their usefulness is what it tells us about the market, rather than so much how it enables us to foretell where interest rates are going. The 5 theories that we will look at initially are the economist's view, followed by the risk premium theory, the inflation premium theory, the time preference theory, and expectations theory. Firstly, let's look at what economics has to say about the rate of interest, where it comes from, what it's related to. There are, in fact, a number of economic theories about interest rates, but the main one is that, by and large, interest rates run counter to inflation. We see this in the monetarist control of the economy that is currently exercised by the Reserve Bank of Australia. As soon as inflation goes up, the RBA immediately comes along and says, well, we can't have that. That means that interest rates are too low, and so let's raise interest rates, because the economists know that by having high interest rates, you will result in low inflation. That tells us that when you have high interest rates, you have low inflation. When you have low interest rates, you have high inflation. And the two, therefore, are inversely related. When we look at the data, we find that the economist's theory of interest doesn't necessarily jump out from the numbers. We have shown here the chart of inflation and interest rates over the last century or so. You can see that inflation has jumped about quite considerably. If we look at high levels of inflation, we see that there was inflation around the time of the First World War. Also, the time after the Second World War, there was a spike of inflation. And then there was a large period of inflation, over 5% per annum, that extended roughly from 1970 to about 1990. During that same period, when we look at interest rates, we find that they were remarkably stable from the beginning of this period right up until about 1970. And so regardless of what was happening with inflation, we can conclude one thing, and that is that interest rates were not causal. They did not cause the inflation. Likewise, there doesn't seem to be the feedback in the opposite direction either. When inflation was high or low, interest rates remained fairly constant. That is up until 1970. From 1970 to 1990, we have a curious period in history. Again, using high rates, and so for high rates we will consider rates of inflation above 5% and rates of interest above 6 or 7% to be what we would consider high. What we see is that from about 1970 to 1990, you had this mountain of consistent high inflation with some lumps and bumps and spikes, but overall it was quite high. At exactly the same time, Although following a slightly different pattern, you also had a record period of interest rates. Interest rates reached peaks of over 15% during that period. Looking closely, you will find that there are a number of periods during that 20-year period where interest and inflation moved exactly in the same direction, hardly supporting the monetarist view. It can be said that in the last 10 or 15 years, the monetarist approach has been quite effective. However, the important thing to note is that there are many other influences that have affected the economic outlook of the community that have caused this sensitivity to interest rates to have really become what it is today. What that means is that in order to adopt the economist theory of interest, we have to ignore too many other influences for this theory to be important. This means that the economist view of interest fails the ceteris paribus assumption, the assumption that says all else being equal. Quite simply put, there are too many other things that are not equal for this view to hold. We now move to the risk premium theory. The risk premium theory suggests that interest rates contain a reward for risk-taking, or conversely, interest rates will be lower as risks are lower. This expresses what is largely a truism. It certainly is the case in the banking industry. You can see that bankers will only lend with premium interest rates when there is a perceived real risk. When we look across the range of investments that are available to investors, we find that these can range from very secure government bonds, which are considered virtually risk-free, up through fixed deposits with banks, which have a very small risk of failure, but then moving into more risky investments on the stock exchange, leading ultimately into high risk, say, mining or startup ventures. There is a convenient theory in finance that combines all of these different risk and return possibilities together. It's known as the capital asset pricing model. The capital asset pricing model, or CAPM model, simply suggests that if we line up all possible investments ranging from the most secure to the most risky, we will find that there will be a straight line connecting them that will also give us an increasing rate of interest. This is shown in the diagram. Generally, the low risk end of investment possibilities belong to the fixed interests or the fixed deposits, the bonds, the debt type of investments. These are low risk relative to the share market, to buying equity shares, which participate in higher potential levels of profitability from companies, but also the risk of major loss as well. So the CAPM model ties together all of these possibilities. There is a certain amount of empirical support for the capital asset pricing model. There is the tendency for very secure investments to return lower rates of return, and conversely with the high risk end of the market. However, the capital asset pricing model does not explain the risk-free rate. That is, if we assume that part of the interest rate is made up of a reward for risk, a form of insurance premium, then what does that say about the rate of return that comes to risk-free investments, such as government bonds? What we find is that while the CAPM model ties together all financial returns, and it certainly does give us an insight into the way that investments are priced relative to each other, it only explains part of the interest rate. Pure interest, risk-free interest, is not explained. A third theory of interest is the inflation premium theory. This theory is a financial management theory, and I stress that because it actually works in exactly the opposite direction to the economist's view of the relationship between inflation and interest rates. The inflation premium theory states that a lender will not lend unless the inflation rate is exceeded. What this means is that if inflation is running at, say, 5%, I will only consider investing my funds, say, in fixed deposits if I get 6 or 8 or 10%. Likewise, if inflation moves from 5 to 10%, to invest in those same investments, I would expect the rate of return to increase proportionally. Certainly this explains lender behaviour, and it is a reasonable expectation, because it's only just that the lender should not incur a loss as a result of lending. We can say that the inflation premium theory operates always, but when we look at the data, we find that there have been periods in history, especially the decade of the 1970s, where even though there's a tendency for lenders to want to get a return above inflation, it doesn't always work out that way. And so what we can say is that inflation premium theory certainly is a psychological theory that explains the disposition of lenders. But whether or not this disposition is sufficient to cause rates of return to move as a lender might want, not always works out in the numbers. A related concern with the inflation premium theory is that the inflation premium theory simply tells us that the rate of return, rate of interest if you like, should exceed the inflation rate. This means that if we subtract the rate of inflation from the rate of profit, we should end up with the net benefit from the investment. This is often referred to as the real rate. Property economists should be very aware of working with real rates, especially in an inflationary environment. But the puzzle remains as to what causes the real rate. How can we explain that? We now move to the time preference theory. The time preference theory is extremely important for property economists to be aware of and to follow in the marketplace, and we'll be looking at a couple of examples. Simply put, the time preference theory is the theory that interest is a reward for illiquidity. That is, if I commit my investment funds for some period of time, the fact that I've surrendered the ability to spend that money and perhaps miss out on opportunities for making profit using my money in other places, what in Latin is referred to as damnums emergens, in other words, losses emerging from the loan, the interest rate should in some way reward me for that possibility of an emerging loss. The time preference theory is best seen in graphical form in what's known as the yield curve. The yield curve is a graph of interest rate against the time to maturity. What this means is that if I look at similar forms of investment, say government bonds, and I take government bonds that are going to mature in a short period, say 12 months, and compare that to the interest rate on the same type of investment, government bonds, but which are going to mature some point in the future, say 10 years, I should see a premium attached to the rate of interest that the 10-year bonds will return compared to the 1-year bonds, simply because I have to wait so much longer and there's so much more opportunity for me to have lost other more useful things to do with my money over those 9 years. The time preference theory and the yield curve are very useful for forecasting, especially to get an idea of where interest rates are going to be moving in the future. While we've described a positive spread between the short-term and the long-term returns, that spread tends to move over time. The difference between those two rates can be used as an indicator of where the market considers interest rates are going to be moving over the medium to longer term. In the extreme is what's called an inverted yield curve, one where the rate of return on short maturities, say the 1-year government bonds, are actually higher than that available on the 10-year government bonds. Why does this happen? Quite simply, because it could be the market's expectation that interest rates over the medium term are going to fall. And what this means is that if I lock my money into an investment over 10 years, and interest rates in 10 years are only going to be half of what they are today, I would be likely to only accept an interest rate lower for that 10-year investment compared to the at call or the short-term interest rate. The time preference theory is certainly worth being aware of, and we will look at applications of it shortly. But before we leave the theory, we have to note that while the time preference theory explains the difference in interest rate between short-term investments and long-term investments, it doesn't explain the at-call rate of interest. By at-call, we mean that rate of interest that is available for very short-term investments. It only explains that extra margin of interest which is added for the long-term illiquid investments. Again, this means that we still haven't penetrated to the core of pure interest after time to maturity, risk, and inflation have been taken out. The first example is Australian government bonds, and we're considering the difference in return between 2-year government bonds and 10-year government bonds. The graph shows in the blue line the difference in rate of return between these two periods to maturity between 1995 and the present. What we can see is that during most of that period there was a slight positive spread, about somewhere in the vicinity of 0.75%. However, between 2005 and 2008, that spread deteriorated to zero, in fact went negative. And the conventional way of interpreting this is that the market considered that in the longer term, the interest rates as a whole were going to be falling. If we go to the lower graph, we find that there was a slight fall in 2008, but certainly not enough to justify the difference in spread. Also, we'll find that the interpretation, certainly the textbook interpretation of using yield curves, needs to be moderated by looking at other factors. The green line in the lower curve tracks the 10-year government bonds over the period from about 1969 to the present. And we can see that there was a period roughly between about 1973 and 1990, or even up to the late 90s, where 10-year government bonds were quite high. They were returning, in some cases, considerably above 10%. However, from the late 90s onwards, they have settled around 6% and seem to have stabilised around that level. This is consistent with the long-term period before about 1970. However, the adjustment out of this period, 1970 to 1990, where the market was adjusting to the new regime of lower rates, meant that the reliability of the yield curve to indicate reliably where interest rates were going was relatively poor. And we can see that in the pink arbitrage line. This pink line gives an estimate of how much better off someone is by investing in the 10-year bonds compared to a series of 2-year bonds over the same period. What that means is if somebody was to buy a 10-year government bond in 1995, they would be about 4% better off compared with buying a series of 5 consecutive 2-year bonds with a maturity over the same period. What this tells us is we need to be a little bit cautious with using yield curves too rigorously to predict the future, because they will only predict the future as well as the majority of people in the market. We'll move now to look at home mortgage yield spread. From the early 90s onwards, fixed interest mortgages became available for home mortgages in Australia. By fixed interest, typically it meant that you were able to lock the interest rate between 1 and 5 years. Here we're looking at 3-year fixed interest periods. And what we see is that the interest rate that is being charged on 3-year fixed mortgages compared to the variable mortgage, that is a mortgage rate which is able to vary almost continuously, tended to fluctuate quite considerably over the 20 years or so that they have been available, roughly between plus and minus 1%. What this means is that different periods over that 20-year period, the 3-year fixed rate has been up to 1% cheaper than the variable rate, the instantaneous rate. Whether or not that discount is an advantage or not can be estimated from the arbitrage line. The pink line shows the benefit that a borrower would have earned as a result of fixing their mortgage for 3 years at any particular point in time, compared with accepting the variable home rate over that 3-year time frame. Again, what we see is that initially there was demand for certainty in the home mortgage market, and so the fixed mortgages tended to actually come at a cost. It cost people who took 3-year fixed mortgages something like an additional 3 or 4% in the early 90s. By the time we get to the last 10 years, we find that by and large taking a 3-year fixed mortgage actually helped to the tune of about 1 to 1.5% at different times over the last 10 years. That benefit seems to have gone from the market in recent times. You'll notice the arbitrage line finishes 3 years ago, and that is because it can't be evaluated unless we have the 3 years of subsequent data to work on. And so whether there is a positive benefit at present from taking a 3-year fixed mortgage when you buy a house or not, nobody can say. Let's review the theories that we've looked at. What we can see is that the risk premium theory takes a slice of interest as risk insurance, and that is a function of how risky the investment is, but it only accounts for part of the interest rate. Another part of the interest rate is taken by the time preference theory, which accounts for the period of illiquidity. A third slice of the interest rate is covered by inflation. However, by the time we look at these three theories, we find that there is still this slice of interest after risk, time, and inflation are removed that is totally unexplained. We can call this pure interest. Now, this is really the stuff that interest theory should be approaching. It appears generally to be running around 2 to 3%, depending on the economic circumstances. Where does this come from? And what determines it? What basis does it have? This is the question we will now approach. In financial theory, this last slice is often explained by what is called the expectation theory of interest. The expectation theory is quite simple. Lenders expect a return on their money. Nothing could be simpler. And likewise, borrowers expect to have to pay for it. While this certainly describes the environment in which we work, it's hardly an explanation. It is merely a description of preference. Because, after all, in various times in history, the mafia have expected insurance money, and their clients have expected broken kneecaps if they don't pay. Another example of the expectation theory. What the expectation theory unravels into is pure demand-based pricing. And what that means is that if I need to borrow money desperately enough, my demand will be sufficient to generate an interest rate. The problem with demand-based pricing is that it is always monopolistic. When the demand function is the only part of the market which sets price, you always have a monopoly, which I guess is why the mafia tends to be frowned upon by most elements of society. There have been a number of attempts to justify the expectations theory of interest, or at least to justify the charging of pure interest. The first recent theorist to attempt this was Irving Fisher in a book titled The Theory of Interest, written in the 1930s. Fisher argued that pure interest is no more than a reward for thrift or patience. And by doing this, he really established, if you like, a moral argument for the charge of pure interest, because what he was saying was that self-restraint should be rewarded, and self-restraint, being a moral virtue, deserves some kind of support. However, conversely, it can also be seen as a penalty for need. Simply put, if I have money that I don't need, I get rewarded. But if I have need but no money, I get penalised. And so it becomes a reward for those who have and don't need, but a punishment for those who need and don't have. Because most borrowing is not done out of an inclination to live well. It's done out of some perceived need, the need to buy a house or fund a business venture. Fisher recognised this and moved on from that theory to the suggestion that interest was in fact a form of participation in the productive profit of useful enterprises. And so this would suggest that if I borrow money in order to fund some business venture that I will make a profit from, then it's only reasonable that I pay a rate of interest out of the excess profit that I earn from being able to use those borrowed funds. It sounds quite reasonable. When we come a little bit closer and look at how to price this discounted profit participation, we have to recognise initially that the lender is not a shareholder, not a partner. When I go to borrow from the bank isn't interested in taking, say, a half share in my profit. They're not interested in whether I make a profit or not. They're interested in charging me a very fixed and certain interest rate, which is going to be charged against me and my estate, regardless of whether my business venture is profitable or not. What that means is that the interest charge is very low risk compared to my business profit. It makes sense that the rate of interest should come at some kind of a discount to the rate of profit. And this is often in a stable economy what happens. And when we calculate with leverage, as we have for a number of our property investment analyses, we'll find that the rate of borrowing is typically less than the rate of return expected on property. The question is, what discount level should we use? Should the rate of profit participation by the bank be 50% of my rate of profit, or 80%, or 20%? And is this reflected in the way that banks charge interest? We find that it isn't. A related question is which level of profit should be discounted? Is it my average rate of profit, in which case the bank is missing out badly when I make a very large profit? But likewise, if I make an extraordinarily bad profit, because perhaps of no fault of my own, should the bank take an interest rate which is some percentage of that? When we think through these questions, we find that it's very hard to justify any fixed level of interest at all. Even if we say the rate of interest should be 100% of the minimum level of profit that I'm likely to make. That's fine as a concept. But what's the minimum level of profit that my business may produce? Could be zero or even a loss. But the bank is unlikely to charge me zero interest rate, or perhaps even pay me to borrow my money. Should it be dynamic? Should the interest rate always be 80% of my profit? When I make good profits, the bank does well. If I make a low profit, the bank takes a small interest rate. We don't see that in the market. And if the bank was to operate that way, we would probably consider their position more like a equity shareholder than a lender. What we find is that Fisher's discounted profit participation ultimately comes back to not being able to justify any positive rate of interest at all, despite its apparent attractiveness. We can move to the great economist John Maynard Keynes. Keynes actually, at different times in his life, suggested a number of different explanations for interest rate. In this presentation, we'll be considering two. The best known and probably most influential was Keynes's notion that interest is a share in the future growth of the economy. By using this theory, Keynes argued that public policy, government policy, should be to borrow money today in order to stimulate economic growth tomorrow, and from that economic growth you have the wherewithal to be able to repay the debt with interest. Keynesian economics was quite popular after the Second World War, and many economists consider that its adoption explained the great economic success of the 25 years or so following the end of the Second World War. However, by the time we get to the 1970s, it was becoming criticised and generally considered outdated. Curiously, in the last 5 years or so, Keynes has had a revival this side of the GFC. However, now it's referred to as neo-Keynesianism. One thing which is important to be aware of is that the point when Keynes was advocating the idea of lending so that an economy is able to pay for their debt out of national growth, he was also a director of the Bank of England. So his theory was very good for the business of the Bank of England. But more particularly, we find that Keynesian theory is in fact a macroeconomic version of Fisher's theory of discounted profit participation. Because what Keynes is really saying is that your interest rate is paid for, in a national sense, out of the national profit, which is expressed as economic growth. Another problem with Keynes's theory is that while quantitatively, as the economy grows, say 2 or 3% over the year, then the community is able to afford to pay the 2 or 3% of interest cost. However, that's not the same as saying that the lender has any justifiable right to that 2 or 3%, merely that the money is there and available. And this raises an ethical question about whether or not Keynesian theory is actually justifiable on that level. We now move to a theorist who brought together the theory of a number of economists by the name of Panico. Panico took some of Keynes's writings, but also a number of other economists, over quite a wide span of theories that extended as far as Karl Marx, to conclude that the interest rate is actually a psychological function. What Panico argued was that unlike Fisher, who argued that interest rate is a participation in profit, Panico turned that around and said that the rate of profit is in fact a function of the interest rate. This would suggest that the interest rate is the prime rate in the economy. What that would say is that it's the rate of profit that is applicable for risk-free, inflation-free investments that can then be used as the baseline to establish the rates of return applicable for all other capital assets. This is very important for property people because it means that if we take the pure interest rate, add inflation to it, and add a margin of risk going from risk-free investments to the property market, we have the cap rate, that percentage which is used by property economists to turn rental return into capital value. What this would say is that our cap rates ultimately come from the interest rates, not the other way around. We'll come back to the significance of this later. But the important thing is that if Panico is right, and there is considerable evidence to suggest that he is, the rate of interest is the primary rate of return in the economy. Moreover, Panico noted that the rate of interest, ultimately the pure rate, the expectations rate, is not set as a result of economic forces, despite what is popularly considered. Panico would say that the rate of interest is set as a result of political, psychological, and social processes, and he marshals quotes from many leading economists who consider the same thing, most notably including Keynes. The implications here are quite profound. What it means is that at the beginning, the very foundation of the economy is not an economic function, but a psychological or political function that somehow has its basis in the political balance between those with money to spare, who want to lend and invest, and those who have needs either in terms of personal needs for, say, food, clothing and shelter, or needs to earn an income, say through borrowing to run a business. This reduces the determination of interest rates to a power relationship. This is important. When we talk in terms of supply and demand, we're always talking in terms of power relationships. Here we're saying that the fundamental quantity in the economy, the interest rate, is the result of a political, psychological balance of negotiating power between two elements of the society. When we move into the political, psychological area, we find that we have to take into account cultural perspectives. When we look across the world and through history, we find that pure interest is immoral in many cultures. Currently, Islam is prominent because of its denunciation of interest as immoral. It's referred to as riba by Muslim scholars, and Islamic finance is organized so as to have profits, but not to have the charge of interest. Likewise, the ancient Hebrews of the Old Testament considered that charging interest was sinful and immoral. So too did pre-modern Europe. In fact, for about 1,000 years, up to about the year 1500, the charge of interest was considered to be immoral and illegal through Europe. Also, across Central and East Asia, we find other instances of cultural sanctions against the charge of interest, often in the midst of practices of exploitative banking. We can even say that customary people, modern indigenous people, if we take the logic of their cultures, while they seldom use money, it can be concluded that the charge of interest would be considered incompatible with their values of tribal solidarity. What we can say overall is that many cultures have considered that setting a charge on the use of money is inappropriate, and in many cases it's considered illegal with the force of law. The cultural philosophical approach to interest was first explored by Aristotle over 2,000 years ago. Aristotle looked at the nature of money and concluded that it was sterile. By this he meant that unlike other capital items, such as cows and houses and maybe paddocks, all of these are able to provide some human good, some useful product, simply by being available. Whereas if we look at money, while money is valuable, it doesn't actually produce anything. Of itself, it doesn't produce more money. Cows produce more cows. A field will produce grass if it's left alone. A house will provide shelter without any change to itself. Whereas money doesn't provide anything useful for humanity at all. This argument is very simple and goes to the very heart of why it is that it is reasonable to charge anybody for anything. We pay either to obtain the good that we buy, say when we buy a loaf of bread or a pair of shoes, or we pay for the service that something is going to afford us while we have it in our possession, even though it isn't ours. We do this when we rent a house or a farm, or maybe hire a car or a machine. The modern mind has great difficulty in seeing the distinction between the productivity of a house or a machine and the productivity of money, because they're familiar with the availability of bank interest. I might say, well, this sterility argument doesn't stack up because I can put my money into the bank and obtain interest. However, if I look closely at how the bank get the money to pay me interest, I find that they only do it by loaning out their funds, my deposit, at interest. This means that the problem of interest doesn't stop with the bank giving me money. It actually goes back to what the bank does with it, which is to lend it out. The person who borrows money from the bank will do it to, say, buy a house or a business. This means that the borrower makes money to repay the loan by turning the money into something else, something productive, because money is not productive. Looked at in this way, Aristotle's argument is eerily powerful, even though it's not a part of the culture we inhabit today. From this, Aristotle concluded that if money is sterile, then it doesn't justify any positive return, any charge of interest. And so Aristotle considered that the charge of interest was in fact immoral, a form of theft. Something like 1400 years after Aristotle, Thomas Aquinas concluded pretty much the same thing. He took Aristotle's argument of sterility and took it one step further. Aquinas reasoned this way: when I loan you money, the first thing you are likely to do with it is spend it. This means that the first thing you do with the money I lend you is use it for the very thing that it is meant to do. Again, this is an unfamiliar approach to argument for the modern mind. The question of what money is meant to do, what you can use it for, these are unusual questions in our time. Money is a store of value. When we spend it, we get value to the quantity of its face value and no more. Once I get that value, the money is gone. If I go down to the shop with $10 in my pocket and I buy $10 worth of things, I come back with $10 of value, but I do not come back with $10 of money. This is very important because for Aquinas, he could see that the $10 of value that I might have in my pocket, say in the form of some useful and possibly even productive thing, is quite different to $10 of money. It was the money that I had that is now gone, used up. You can ask the question, how is it justified to charge an ongoing fee for the use of something that no longer exists? The $10 of value may exist, but that's not the same as the money. The value I got from the money was its face value and no more, and it will never, ever give me anything more as a benefit. This means that the obligation that I have is only ever the face value of the money. It cannot be any more because the money is incapable of providing a benefit that is anything greater than its face value, even though the things it is exchanged for may be capable of providing that ongoing benefit. But that's a very different thing. This distinction can be illustrated using the example of another consumptible. If I lend you 2 eggs so that you can bake a cake, I have lent you the cooking power of 2 eggs. I know that when you borrow them, you are going to break them open, destroy them, in using them and getting out their benefit, their value. That means that I have lost the cooking power of 2 eggs. You have benefited from the cooking power of 2 eggs. But once you've used them, they are gone. You can derive no further benefit from them, regardless of what you do with the cake. This means that your obligation to me is always limited to the cooking power that I gave you, which is 2 eggs, regardless of what happens to the cake. If you substitute money for the 2 borrowed eggs and productive assets for the cake, you have the consumptible argument against the charge of interest. Although these arguments are unfamiliar, they're worth becoming conversant with, because if they are valid, they may go some distance to explaining things like the global financial crisis, because they're based on justice arguments and the facts of what money is and how it works, regardless of whether we are currently operating in conformity with these essential justice issues or not. The modern objection, though, comes back that how do we get capital funding if at the base of it the charge of interest is problematic? This leads us to the related question of comparing equity funding with debt funding, because we find that in the Islamic world this is effectively how their banks operate. The question of debt funding versus equity funding is very important, especially for real estate. In Islamic banking, while the bank provides funding for entrepreneurs, it does so on the basis of what is effectively an equity relationship. However, in Australia, especially in property, the use of debt funding for property investment and development is far more common, although it can be linked in no small way both to strong profits in the good times, but also major problems in poor times. Let us consider a simple example. You intend to make your living as a dairy farmer
but you do not have the resources to buy a cow. I have the money sitting available that I want to invest. My money buys a cow that you milk, and we agree that we share the milk 50-50. In that dairy business, we can either be equity partners, in which case, if your dairy business works well, I share more milk. If the cow has a calf, we will both profit because I own the equity, you own the labour, and we're partners. However, if I lent you the money and the cow has a calf, say exceptional profit, then you benefit more than I do. And so in a debt relationship, the profits are magnified. By contrast, if we were equity partners and the venture is less productive, say the cow dies, I would lose my capital and you lose your income, and we would be left to go our own ways. However, if I lend you the money and the cow dies, you would lose your income, but you would still owe me the money that I lent you with interest. Your interest obligation previously was expressed as half of the milk of the cow. Now you have no cow, but still the obligation to pay me the equivalent of what was previously your entire income. How long will you be indebted to me under this condition? Basically, forever. And so this simple illustration shows that while there are benefits in good times with debt funding, possible downsides in poor times can be crippling for the debtor. Historically, this has been shown again and again, especially in parts of the world such as India or ancient Greece, where over a period of time, the levels of indebtedness and permanent dependency upon lenders became so great as to virtually enslave entire populations. This led to the ancient Hebrews having a proverb that simply said, "The borrower is the slave of the lender." The success of Islamic finance, which is limited by religious reasons to provide equity participation funding, is an illustration that equity does work for both development and property investment. However, it doesn't offer the benefits in the good times of debt, which has proven to be very attractive in the West. The close connection between debt and property purchase is so strong that it is important for the property economist to understand the relationship between banking and the property market, because in most Western countries, the banking and in fact the money system itself is largely supported by its backing effectively in property debt. This creates a set of unique and complex interrelationships that affect the society's total quantity of money, the economic viability of households, and the structure of property values. These are all interrelated, and the property economist needs to have a feel for the strength of these interrelationships. In developed Western economies, most money is created purely from the banking system. The basic cash currency is backed in Australia, the United States, and most other Western countries by government bonds. This means that the government borrows money from the private market and uses that to back the money that it prints, the coins and notes. This only accounts for about 5% of the money in use in an economy. This means that the coins and cash that you might see are actually the result of the government borrowing money, borrowing value from the private market in some ways. The earlier notion of backing currency by gold or silver has been superseded over the last generation or so because it presented certain problems for international finance. 95% of the remaining money which circulates in the economy is actually generated by the banking system itself. And this comes as a result of what is known as the credit multiplier effect, or sometimes referred to as fractional reserve banking system. What this means is that the money created by the banking system is actually backed by loan collateral, the security taken on loans, and this is mainly property. Hence, property becomes the de facto backing for the great majority of a country's money. We will look at how this works. The bank multiplier effect works on the fact that the bank does not hold its deposits simply within the bank. It only keeps a small fraction as a reserve deposit. The rest is loaned out. It works this way. If you deposit $100 into the bank will hold a small fraction, let's say $10, and lend the rest out. The borrower will most likely use the borrowed funds to buy something fairly soon after taking their loan. This money usually finds its way back into the bank by way of a deposit from the vendor. And so the $90 that is borrowed from the bank finds itself back as a separate deposit. The bank then has an extra $90 available for loan. That $90 might have $80 lent and $10 kept as a reserve deposit, and the process continues. In this way, your $100 original deposit can be anything up to 10 or even 20 times multiplied by the banking process. Since a major part of bank lending is lending into property, and those loans are secured by the property themselves, the subsequent deposits that are multiplied out of your $100 are largely created and backed by the security, by the property. In this way, the property market implicitly provides a backing for the majority of the money which circulates within the community. This should be important to property economists because it underlines the importance of sober valuation. Because if the valuations are allowed to give an inflated view of property values, then this can have repercussions back through the money system into the entire economy. And of course, this is one of the contributing problems to the recent global financial crisis. While this may appear to be a rather precarious way to supply money to an economy, it turns out that the other 5% that is obtained through the government borrowing money directly from the private market is also not without its certain complications. The problem with the debt-based currency that we currently use is that when the government borrows from private lenders in order to have the reserves to print cash, the difficulty is that that represents all of the money that the government has produced. When it comes time to repay those loans, they must be repaid with interest. This means that the government, at least notionally, has the obligation to repay a greater volume of money than it borrowed, which is very difficult when there is only exactly that amount of money in the economy. The government can never repay the principal plus interest. This means that the government must then borrow even more money to cover the original principal plus the interest. And in this way, the government indebtedness due purely to the necessity to provide currency for the economy rolls up over time. This rolling up of government debt due to the way that money is created is relatively new. In the United States, it goes back to the beginning of the American Central Bank, the American Federal Reserve, in 1913. And so the problem has only been brewing for about a century. While it was not considered important earlier on, the events of the last years have focused a certain amount of concern over the use of debt-based money is in fact prudent. These problems with the origin and cost of money are of massive importance for property economics because they point out the difference between financial wealth and real wealth. This is often confused in the real estate world. If I own a house, I own a house. It is capable of satisfying the needs of one household's dwelling needs, a family's dwelling needs. If that house costs $1,000 or $100,000 or $100 million,
If we're talking about the same block of land with the same building and improvements, the number of dollars is totally irrelevant. The utility and benefit is still that of one house. This means that capital growth and inflation generally are to a certain extent illusory from the point of the community's ability to provide wealth and improve itself in terms of economic growth. This has often been lost, especially over the last generation, through these periods of high growth, high inflation, and high interest rates. The focus, therefore, needs to always be not too far away from physical production. While this is important directly for real estate values and the directions of real estate markets, it also is important as an indicator or a test of where the economy is going in general. And that is very important because if the economy is growing, then real estate values will grow. In some cases, the gap between financial wealth and real wealth lead to a number of misconceptions. A number of financial indicators would suggest that the economy is going well, when, for instance, the real estate market is booming, by which we don't mean that there is more real estate available or more space available necessarily, more houses or factories, but simply that the prices paid for any particular piece of real estate space has gone up. Likewise, when the stock market is booming, we think in terms of stock prices booming, not necessarily improvements in the ability of the companies that the stocks belong to become profitable. There are a number of strategies which can play on this apparent dilemma in the meaning and significance of these two types of wealth. For instance, in Australia, many companies have discovered that they can increase their profitability and therefore their stock prices by actually reducing the physical level of their productivity. This is usually done by taking apart their local productive capacity and either relocating it offshore or simply buying comparable products from cheap manufacturing locations such as Korea. When companies opt to take apart their domestic productive capacity and replace it with effectively turning themselves into importers rather than producers, often their productivity and all of their financial indicators improve. However, their economic strength is reduced because no longer do they have the ability to produce things themselves and therefore have a degree of independence from the vicissitudes of the productive side of the business. They rely purely on being able to buy things from others who may choose to put their prices up, perhaps in the same way that the Middle Eastern oil producers chose to put their prices up and affect the entire Australian economy through the costs of the imported oil. For companies in the short term, that means increased economic profitability, but for the community in general, it means a weakening. The real weakening in the economy is often reflected in an influence that will weaken the respective property markets. And so we see in parts of Australia where the economic strength has been reduced through these processes, say the productive manufacturing areas of Newcastle and Wollongong, or the rural productive areas of many parts of regional Australia, where the industries that supported those centres have been relocated offshore or simply taken apart, their real estate values have fallen. Likewise, there is the tendency to privatise infrastructure, which again returns apparent short-term benefits for the community, but at the expense of the long-term economic strength of the country. And again, it's on the basis of the long-term economic strength of the country and the direction of the economic strength that ultimately underpins the long-term directions of real estate.